Hey everyone, REITs have had a pretty big roller coaster ride here in 2024. They were in the doldrums early in the year, but then starting in July up through the end of the summer and early fall, they experienced a very strong rally because the market fully made up its mind that yes, now was the time. The Fed was getting ready to pivot to rate cuts. Inflation seemed to be coming down. And so with it, long-term rates were starting to come down and REITs surged. They were one of the biggest outperformers. However, in recent months, sentiment has shifted somewhat. And this is largely due to the fact that inflation has not come down as much as the market expected it would. It's been pretty resilient at between 70 to even a little over 100 basis points still above the Fed's target rate. The last few readings have shown that it's actually, if anything, ticking back up again. Donald Trump's reelection has increased confidence that the economy is going to remain stable, plus his tariff policies could prove to be inflationary, at least in the short term. And so for those reasons, the market is less optimistic about inflation coming down, interest rates coming down, so long-term rates have actually ticked up again. And so this has weighed on the REIT sector because REITs are pretty interest rate sensitive. So as a result, there have been some REITs that have really pulled back, yet I don't think that all REITs are going to suffer the same. In fact, I think some REITs didn't really participate as much in the rally as they should have to begin with, and I think their long-term outlooks are very attractive. And so I think that there are some really attractive places to deploy capital in the REIT sector today because I think the market is overly pessimistic on several of them. And so in this video, I'm going to discuss 3 REITs that I would buy ahead of 2025 if I could only buy 3. Before I get into these names, though, if you could please give the video a like, I would greatly appreciate it. Thank you so much. Okay, so what's the first one? The first REIT is BSR REIT. Now, I've discussed it in previous videos. I've spoken to the CEO in the past, shared some of the insights with you guys. But the bottom line is that it still remains very undervalued. It trades at about a 20% discount to its net asset value, the private value of its apartments net of the debt that they have. It has multifamily assets that are fairly new build. They're Class B assets located in Sunbelt markets, primarily in places in Texas like Austin, Houston, the DFW area, a couple in Oklahoma, places like that. And I am very, very bullish on this setup because, first of all, Class B apartments, they tend to do pretty well in all economic environments. They're nicer, especially the newer build. They're nicer than Class C. And so they are in demand. People want them when times are good, even when people are prospering more. You know, Class B is still a nice place to live. Whereas during economic hard times, they are much more affordable than Class A apartments. And so, you know, during good times, people who would normally maybe live in a Class C upgrade to Class B. And bad times, people who would normally live in Class A or maybe even rent a single family home but need to save money might move down to a Class B. The other reason I like it, again, is the location. That's the key to real estate investing: location, location, location. You've probably heard that. Well, with their concentration in Sunbelt markets, especially in Dallas, they set themselves up for strong demand for years to come because there is strong population growth in places like Texas. A lot of in-migration to Texas from places like California, New York, Chicago, and certainly south of the border. People are coming here because you have pro-business environments. So a lot of businesses moving here, and so a lot more jobs. You have people coming here for the lower cost of living, housing, food, et cetera, is all cheaper here than places like California, New York. And with the rise of remote work, people can live wherever they want. They like Texas because of the lower cost of living. The taxes are generally lower here. You have no state income tax. You also have a warmer climate. Right now, it's pretty nice day. Sun is shining. It's, about 10 days before Christmas, and we've got the sun shining, and it's very moderate weather right now. In some places you got snow blizzards, frozen conditions, or at least very cold and miserable. And so, Texas is a nice place to live, especially in the colder months of the year. And so that's another reason people who can live anywhere may choose to live in Texas, especially in North Texas. You don't have the hurricane threat that you have in other Sunbelt, friendly climates like, say, for example, Florida, which is low tax as well and business friendly, but you have the hurricane threat there. And so that's another benefit of Texas. Another thing is there's a huge movement in Texas right now to eliminate property taxes, or at least cut them dramatically and put them on the path to elimination, because property taxes have typically been pretty high here in Texas, and they've gone up a lot in recent years. But now there's momentum pushing them down. The last session, there was some cuts that were made. I think this next session, even more will be made. And given that BSR REIT is a multifamily REIT, they own a lot of these residential properties, and so property tax cuts will help them a lot. They helped them last time, a big time. They're probably going to help them even more moving forward. So that's another, I think, underappreciated tailwind for the company. They recently hiked their dividend by 7.7%, which is a big dividend hike for a company that has a yield over 4%. For a REIT, that's pretty impressive. They have a strong balance sheet because through the recent period of higher rates, they've been very disciplined and not investing in properties that were not very attractive when accounting for the higher cost of interest. And so instead, they've been buying back their own stock at huge discounts to net asset value, but they've also been buying down debt and building up a lot of capacity on their balance sheet so that if and when interest rates fall or cap rates start to go up, they can then buy properties or develop them at attractive spreads. And so they're in a good position. They're increasingly a coiled spring ready to surge forward. Meanwhile, they have that opportunity to just keep buying back their own equity at steep discounts. And insiders are heavily aligned. They own a lot of the stock. They believe very much so in their company and their investment proposition. So again, on a risk-adjusted basis, BSR REIT may not soar this next year, but on a risk-adjusted basis, I think it's one of the most compelling opportunities, if not the most compelling opportunity in the entire REIT sector right now. Okay, another REIT that I really like right now is Armada Hoffler Properties. Now, it's a misunderstood REIT. It trades at a big discount to its net asset value as well. It has about an 8% dividend yield right now, and so you would think high risk. And that's because it has a pretty substantial exposure to office real estate. And obviously, office has been in the doldrums. You have the work from home phenomenon going on. And, a lot of these office spaces, especially in big markets like New York and San Francisco, have been suffering vacancies because of companies leaving the area, people moving away, or work from home on the rise, or companies just simply moving to places like Texas, as I was just discussing. But AHH, which is a ticker symbol here, is not like that. And there are two big reasons why. One, its assets are focused in more business-friendly climates in the Southeast. And it's very targeted in those markets, specializes in them. But second of all, people don't realize that AHH's properties and its REIT structure is increasing toward a mixed use, a work, live, play setup, rather than just an office pure play. In fact, only 2% of its total ABR comes from actual office properties. The vast majority of its income either comes from multifamily properties, Class A retail properties, or from office assets that are in a mixed-use environment where they're alongside multifamily and retail properties all in the same complex. And so they're more competitively positioned. They synergize with each other. If you live in one of those multifamily places, you're close to where you work, you're close to where you shop. And so it saves you a lot of money. You don't even need a car in some cases, or at least you don't use much gas. And so it's a very nice place to live. And so these assets are competitively advantaged. They synergize with each other. And that's evidenced by the fact that, again, they have very high occupancy rates, 95% plus across all three, in the multifamily, retail, and office. All three of them each have over 95% occupancy rates. And so, again, these properties are vibrant, they're thriving, they're doing very well. AHH also has recently paid down a lot of its debt. The market didn't like it. They issued a bunch of equity at about a 9.5% FFO yield to pay down a lot of their debt. Now, at the time, that wasn't great, but I wasn't a shareholder, so I didn't care. And now, as a potential new shareholder, I actually really like that they did that, because now I would be buying in at a very much lower leverage rate, a more solid balance sheet. Meanwhile, I'm buying in at an equity price that is already accounted in that dilution, has already a big discount to net asset value. So I don't really care. They already did that in the past. And the dividend is still covered. Coverage is a little bit tighter because of that equity issuance, but it's still covered. Again, their properties are thriving. They have some development properties underway that once they're brought into active cash flowing state, that's going to further bolster the dividend coverage ratio. And so when you get an 8% yield, high quality, well-diversified real estate portfolio, well managed by management, you've got a development pipeline underway, you've got a freshly deleveraged balance sheet that is not perfect, but it's in pretty solid shape. What's not to like? Buying assets at a discount to their private market value that are high quality assets, well managed, solid balance sheet, very attractive dividend. Again, I think on a risk adjusted basis, AHH is one of the most compelling opportunities, especially for more aggressive investors in the real estate space right now. And then finally, for my really defensive investors who just want that steady dividend, a strong sleep well at night balance sheet and portfolio, there's WP Carey. And I've talked about them in other videos. You guys have heard about them. You're probably sick about hearing about them. And the stock doesn't really move much, but that's okay. If you're not looking for a get rich quick scheme, if you want that, buy Bitcoin or some other highly volatile asset. But if you just want that steady Eddie dividend, that 6.5% yield, that's likely going to grow at a pace that meets or beats inflation over time, with that BBB plus credit rating, that very well positioned, well diversified triple net lease portfolio that's primarily industrial, warehouse, and strategic retail, mission critical retail assets, with some diversification to Europe, the United States, enables them to get more attractive interest rates, allocate capital more opportunistically between the two markets. That's what WP Carey offers, and the valuation is very cheap, trades at roughly in line with or a slight discount to its net asset value, despite historically trading at about a 10% premium. Again, that dividend and AFFO per share growth is expected to come in around 5% a year. The dividend is expected to grow in line with it. So when you have the 6.5% yield, the roughly 5% growth rate, that puts you at 11.5% total return without even accounting for potential valuation multiple expansion, which could move it into the mid-teens. Again, alongside a relatively low risk, a battle-tested, recession-resistant business model with a strong balance sheet. And so again, if you want low risk with high yield and decent total return outlook, I think WPC is probably the best choice you could ask for, whereas AHH is probably the highest return, highest risk proposition there. You could potentially get a 20% or even higher CAGR on that over the next few years between the valuation multiple expansion, the growth, and the yield. But again, there's higher risk there because of the balance sheet leverage, and the property class is a bit riskier. And then BSR REIT's probably in between those two because its balance sheet is strong, its assets are quality, but not quite as well diversified or as high credit rating or perhaps as secure of long-term leases as WP Carey has. But they trade at a bigger discount to NAV. They have higher potential growth over time, and their yield is still pretty attractive. And so I'd put them kind of in between the two in terms of total return potential and risk. So there you have it. If you found this video insightful, helpful, please subscribe to my channel. I'd really, really appreciate it. Thank you so much. Have a great day.